Stop scrolling. I mean it stop. Because while most people were busy with work, bills and daily life, the US stock market just crossed a level most investors never thought they would see. The S&P 500 has crossed 7,000 points for the first time in history. And what happens after moments like this is what separates smart money from emotional money. If you care about your money, stay with me for the next few minutes because this rally is not as simple as it looks. Let me tell you something most headlines won't. Every major market milestone creates two groups of people. One group celebrates, the other prepare. And history shows us the second group always wins. So before you leave this video thinking market are strong, everything is fine, you need to understand what's really driving this rally. What just happened? The S&P 500 crossing 7,000 is not just a number, it represents confidence, liquidity, and belief in the future. This rally is being what just happened. The S&P 500 crossing 7,000 is not just a number, it represents confidence, liquidity, and belief in the future. This rally is being driven mainly by technology stocks, strong earnings, and massive optimize around artificial intelligence. Companies involved in AI, cloud computing, automation, and data are attracting global capital at record speed. And because of this, US markets are sitting near all-time high. Financial media is bullish, social media is bullish, retail investors are bullish, and whenever everyone agrees one on direction, markets usually remind us who is control. Here is a simple question for you. If markets are so safe right now, why are professional investors quietly buying protections? The AI opportunity or risk. Let's talk about AI because this is the heart of the rally. AI is real, AI is powerful, and AI will reshape industries. But here is where investors get confused. A revolutionary technology does not automatically mean every stock is fairly priced. In the late 1990s, the internet changed the world, but many stocks tied to internet still collapsed. Not because the technology failed, but because expectation become unrealistic. Today, AI is doing something similar. The future is being pulled forward into today's stock prices. And when expectations move faster than reality, volatility increases. Warning signal, and this is the part most investors ignore. Markets don't warn you loudly, they whisper first. Market structure. Why this rally is unique? This rally is not broad based the way many people think. A small group of large tech companies is responsible for a huge portion of market gains. That means the index looks strong, but underneath, not every sector is equality healthy. When leadership becomes narrow, market becomes fragile. One earnings disappointed, one policy shift, one macro shock, and sentiment can change very quickly. That doesn't mean a crash is guaranteed. It means risk is asymmetric. Upside is lower, downside is fast. Why the world cares? This is not just an American story. The US stock market is the engine of global capital. When the S&P 500 hits record highs, money flows into risk assets across the world. Emerging markets react, currencies react, commodities react. Even investors who never bought a US stock are affected indirectly. That's why milestones like this dominate global headlines. They shape global investors' psychology. The dangerous part, let me be very clear here. Market don't crash when people are scared. They crash when people feel comfortable, when volatility is low, when optimism feels logical, when risk feels invisible. Right now, the dominant belief is technology will save everything. Maybe it will long term. But markets don't move its straight line, and every historical rally tests investors' discipline before rewarding patience. If you are watching this video, you are already ahead of most people because you are not asking how high can it go. You are asking what I am missing. What smart investors do now? Smart investors don't panic. They don't blindly chase either. They manage risk. They size positions correctly. They stay patient. They understand that protecting capital is more important than chasing headlines because missing a little upside is survivable, but ignoring risk is not. If you want content that goes beyond hype, beyond fear, beyond noise, subscribe to this channel because the next phase of this market will not reward emotions, it will reward understanding. Stay informed, stay disciplined, and I will see you in the next video.